Price elasticity of demand and total revenue. This lesson explains the significance of the price elasticity of demand, PED. Price elasticity of demand is a measure of the degree of responsiveness of quantity demanded, following a price change. Producers or sellers require the knowledge of the PED of their products to ascertain the impact of a price change on consumer expenditure, and by extension, their revenue. Therefore, it is considered in deciding to change the prices of goods and services. How do we calculate the PED? PED is calculated by using the formula percentage change in quantity demanded divided by percentage change in price. What is total revenue? Total revenue is the total amount realized from sales. Total revenue is price per unit times quantity sold. The total revenue formula is a function of price and quantity. Therefore, it will increase when either price or quantity is increased. It will reduce if either price or quantity decreases. Let us examine the relationship between relatively inelastic demand and total revenue. Demand is relatively or fairly inelastic if a change in price leads to a smaller change in the quantity demanded. The PED is less than 1 in this case. For example, the PED is 0.3 if a 60% increase in price leads to a 20% fall in quantity demanded by consumers. The PED is calculated by dividing 20% by 60%. In this example, the quantity purchased by consumers falls by a smaller percentage, 20%, following a rise in price, 60%. The total revenue will rise because the increase, 60% price increase, is more than the fall, 20% fall in quantity. This means that for relatively inelastic demand, an increase in price will cause a rise in total revenue because the quantity demanded will fall by a smaller percentage. A rise in the price of a product with relatively inelastic demand is shown graphically. The price rise is bigger than the quantity fall, resulting in a rise in total revenue. For relatively inelastic demand, a reduction in price will cause a smaller increase in quantity demanded. For example, a 30% fall in price results in a 15% increase in quantity demanded. The PED is 15% divided by 30%. PED is 0.5. It is relatively inelastic because it is less than 1. There will be a decrease in total revenue as the fall, 30% in price, is greater than the increase, 15% in quantity demanded. Therefore, it is not advisable to reduce the price of a product with relatively inelastic demand as revenue will decrease. Rather, a price increase is desirable because revenue will rise. Examples of products with inelastic demand are basic food items, petrol, alcohol, and cigarettes. A reduction in the price of a product with relatively inelastic demand is shown graphically. The price fall is bigger than the quantity increase, resulting in a decrease in total revenue. Next, we are going to examine the relationship between relatively elastic demand and total revenue. Relatively elastic demand implies that a percentage change in price leads to a greater percentage change in the quantity demanded. The PED is greater than 1 when it is calculated. Let us first look at what happens when the price of a product with relatively elastic demand is increased. For example, a 10% increase in price leads to a 25% fall in quantity demanded. PED is 2.5. The answer is obtained by dividing 25% by 10%. In this example, the quantity demanded falls by a bigger percentage, following a rise in price. Therefore, total revenue will decrease as the fall, 25% fall in quantity demanded, is greater than the rise, 10% rise in price. A rise in the price of a product with relatively elastic demand is shown graphically. The price rise is smaller than the quantity decrease, resulting in a fall in total revenue. What happens to revenue when there is a reduction in the price of a product with relatively elastic demand? As an example, a 13% decrease in price results in a 17% increase in quantity demanded. PED is 17% divided by 13%, which is 1.3. PED is relatively or fairly elastic because it is greater than 1. Revenue will rise as the decrease, 13% in price, is smaller than the increase, 17% in quantity demanded. Therefore, sellers stand to benefit when they reduce the price of their products when demand is relatively elastic, because revenue will rise. An increase in price, on the other hand, will cause revenue to fall. A fall in the price of a product with relatively elastic demand is shown graphically. The price fall is smaller than the quantity increase, resulting in a rise in total revenue. Let us consider the relationship between unitary elasticity of demand and total revenue. PED is unitary when the percentage change in price results in an equal percentage change in the quantity demanded. PED is 1. For example, a 20% rise in price leads to a 20% fall in quantity demanded. The PED is 20% divided by 20%, which is 1. Total revenue remains the same because the price rise, 20%, is equal to the fall in quantity demanded, 20%. In conclusion, for unitary elasticity of demand, revenue remains unchanged, whether the price is increased or decreased. A rise in the price of a product with unitary elasticity of demand is shown in the diagram. The price rise is the same as the quantity fall, making revenue unchanged. Because PED affects consumer spending on goods and services, it is also useful to the government. Taxes increase prices and influence the amount purchased by consumers. If demand is fairly elastic, a rise in tax will increase prices and cause the quantity demanded to fall by a larger percentage. Tax revenue would decline, owing to a larger fall in consumer purchases. However, tax revenue will increase as a result of raising taxes on products with fairly inelastic demand. This is because the quantity demanded would only fall by a smaller percentage, following the price increase caused by the tax. We are going to solve a question to further clarify the relationship between PED and total revenue. A firm is considering raising its price. If the price is increased from $1,000 to $1,500, quantity demanded will fall from 200,000 to 150,000. A. Calculate the PED. B. What is your recommendation? We are using the PED formula for the first part of the question. PED is percentage change in quantity demanded divided by percentage change in price. Percentage change in quantity demanded is Q2 minus Q1 divided by Q1 times 100. This is 150,000 minus 200,000 divided by 200,000 times 100. The answer is minus 25%. Percentage change in price is P2 minus P1 divided by P1 times 100. This is 1,500 minus 1,000 divided by 1,000 times 100. The answer is plus 50%. Therefore, PED is minus 25% divided by plus 50%, which is minus 0.5. The PED is 0.5 because we normally ignore the minus sign. Let us answer the second part of the question. Our recommendation. The PED is relatively inelastic. The firm should increase its price, because the price rise, 50%, outweighs the fall in quantity demanded, 25%, which means total revenue will increase. We can also cross-check by calculating the total revenue at each price. Total revenue before the price rise is $1,000 times 200,000. This gives $200 million. Total revenue after the price rise, $1,500 times 150,000. Revenue is $225 million. This means by increasing the price, revenue will increase.